All right. So Sunday fun day. This is a day I like to get prepped for the week. Think about what's happening in the markets, what kind of large scale activity is taking place. And then usually I try to key in on one or two big themes for the week, as well as just maybe other things that I'm not considering. What I want to do today that would be kind of interesting is I want to cover three topics. The first is I want to talk about major railroad acquisition and what it's going to do to the rails in North America. I want to talk about the lack of diversification in many portfolios that I'm hearing about on YouTube and how there's almost an effort to double down on diversification by accident. And then third and finally at the end, I actually want to share some original stock certificates I have from the railroad space because I thought, hey, what a great transition with a big acquisition happening in the market. I actually own some original railroad stock certificates and they're kind of cool things. And, maybe you've never seen one before or just curious what they might look like. So let's start here. Pretty big news coming down the M&A world. Canadian Pacific is buying Kansas City Southern for $25 billion. This is significant because these are large railroads. That's a space that not a lot of people think about when they're investors. Railroads seem very, I don't want to say boring is the right word, but I would say very much not something that everyone thinks about, right? Railroads don't always come to mind. It's not the high flyers. It's not the tech stocks of the world we hear about every day. But railroads are interesting because they really are the infrastructure that keeps our country moving and they keep the economy moving. The ability to ship large volumes of material across ground has a number of advantages. Dry goods, wet goods, building materials, you name it. These trains are not the trains of the past. We know from when we were kids watching them on TV. These carry massive amounts of materials over vast and very rough terrain, frankly. So this is particularly interesting, though, in the case of Canadian Pacific and Kansas City, because, number one, $25 billion is obviously a huge price to pay. It is a premium over the current share price of Kansas City Southern. But I think even more so than that, it's the fact that now with these railroads coming together, we're going to have 20,000 miles of rail line connected under one company. And what this really means is that now Mexico, US, and Canada will be connected under one railroad here in the end. And I don't think I have to tell anyone who watches this channel what that means. This means that there's scales of efficiency. This potentially means that we can move things in better and faster ways. We can move material at greater speed than we were before. This also consolidates the need to do transfers. It consolidates the need to consider who has to get to what point and then switch to a different rail company. This also means that for the folks who are doing the shipping of their own materials, there could be some effectiveness and efficiency in how they go about negotiating. This could mean that materials are getting out in a faster or better way, frankly. Now, that all said, it's speculation. We don't know if that's really how it's going to be, but I think these are the kind of mergers that, don't get a lot of attention. You're not going to see it on the news. No one on YouTube's blogging about Canadian Pacific and Kansas City Southern, but I think these are the things when you're a real investor and a real trader and you're really trying to grow that wealth, these are the things that are big. These are the things you need to listen to. It's not about Google fighting the SEC or Elon sending a new tweet. Those things are great and they're cool and they're fun to hear about. It's not about Bitcoin breaking new levels. Agreed. I love it too. These are the fundamental movers of our economy. This is how we move goods to where they need to be. These have been in place for literally sometimes hundreds of years at this point. So I think it's actually really exciting to think about the fact that such an old industry is still consolidating, still bringing goods to market, still acting in the best interest of growing those pipelines, getting the rails laid, making sure we're connecting multiple countries here in North America. I think it's particularly interesting from the standpoint of just when you think about the scale of these two players coming together for 20,000 miles of rails. That's pretty darn amazing. Obviously I'm excited about this. And at the end, I'll actually show you why. It's kind of a fun little thing I started putting together a while back. And, as someone who's really interested in the markets, has been around for a while, I am certainly not trying to be one of these historian type guys. I just happen to think it's very interesting to see how capital markets work, the way that companies have grown over time, the way M&A activity continues to push that forward. But I'll save the stock certificates till the end to show you what those look like. The next thing I really want to bring up, and this is a direct response to a message I got on our Facebook page, where we've got about 6,000 people following the page. So we get a pretty good amount of inbox messages on there, as opposed to on YouTube, where it's not so many folks. I had kind of phrased a question out there and said, how are you managing to diversify your portfolio if you're relatively new or don't really know what you want to pick? And maybe stocks aren't the thing that you feel comfortable going after. And of course, the theme we heard was, oh, well, I leverage index funds or mutual funds, or I look for like broad-based market ETFs. Great, totally cool. But when we dug in a little bit further into this, there were sort of, almost like an alarming moment when I realized what folks think was diversification was really just buying the exact same food in a different container. They're buying lots of different pizza boxes, but at the end of the day, it's just the same pizza in every single box. And I'll give you some examples of what I'm talking about. VTI by Vanguard, their total market index, is massively popular. Tons of folks are leveraging that, especially in the early retirement and financial independence space. We hear about VTI all the time. We hear about SPY, the Spider Index. We hear about QQQ, right? We hear about SDY for dividends. The list goes on. These are all broad-based, market-based stock market holdings that try to get as big of a sort of grab of the overall market, often in a weighted format. So the largest companies get the most weighting in that underlying portfolio of the index. What was so alarming, and I actually have seen several videos talk about this on YouTube as well. And by the way, I always say this, and I think it's worth noting, is I think that everyone does have the best intention and they're trying to deliver the best kind of advice. But I do also think that not everyone knows how to look and understand beyond maybe that first layer of what they're investing in. Like, you might like the idea of a total market index. But do you know the top holdings? Do you realize that the top holdings in that might be the same as like 10 others? So you think you're diversifying because you're buying across multiple ETFs or indexes or mutual funds. And what you're really just doing is buying the exact same bundle of stocks over and over again, but now tied to an underlying index price or price model. So what I would really urge you is, if you're holding multiple global stock portfolios within an index, an ETF, an S&P 500, a US NASDAQ or New York stock, or NYSE, look into the portfolio and try to understand what are the top like 10, maybe 20 holdings. And what I think you're going to find is they're pretty much identical. Like, it's the exact same companies all held, maybe slightly different weightings, maybe slightly different underlying percentages. But the nuts and bolts of it are, you're probably just buying the exact same companies inside of a different pizza box as the one you already had and the one you already had. So I really, as always, urge you, do a little bit more due diligence. It's not just about price. It's not just about dividend yield. It's about really understanding like what are the makeup of the index funds you're buying. I think index fund investing has obviously become wildly popular for good reason. I think it's a great way to build scale. It's a great way to manage your portfolio if you don't really know how to build one the right way, or you don't have time to or the desire to. But man, please be careful, because you could end up just owning tons of the exact same stocks. And a lot of times they're the stocks we hear every day on the news. So, you might be going out and buying VTI, SPY, QQQ, whoever, and then you're still going and buying Google or Amazon or Tesla or whoever else. And what you're really doing is just continuing to de-diversify as you're getting more and more holdings in the exact same weighting in the exact same way. So you think you're going out and really spreading your risk out, but if one bad thing happens, they all go down, right? That's not diversification. Diversification is, having different market segments that work in different correlations, right? When one goes up, the other might go down. There's different strategies to take on this. There's long and short strategies you can use within your own portfolio in different sort of easier ways than like what a professional institutional trader might do, or a hedge fund. You can manage this in your own ways. Like, I think if you held a bundle of Vanguard indexes or ETFs, like, across total market cap, maybe mid cap, small cap, maybe some real estate, maybe some international funds, that's diversification against different classes within the market. Simply owning the total market index of multiple companies, right? Like Fidelity, iShares, Vanguard, whomever else, you're just buying the same thing with a different name on the front. So just keep that in mind. And I think that, you can easily find out what those holdings are very quickly and without much effort. So you should definitely do that as well. So I want to end the video with something a little bit different. I've got 4 railroad stock certificates here. And we sort of jokingly call it like the Monopoly 4. This is just something that I do for fun when I see these online, or sometimes you can pick them up really cheap. But these are actually original stock certificates from 4 different railroads. So the first one is the Baltimore and Ohio Railroad Company. You might recognize the B&O Railroad. And this is actually a very early one for 25 shares. Get a little picture of the train on there as well. Just kind of a cool thing, right? I figured what a day to be talking about railroads to start off with Kansas City, Southern and Canadian Pacific. I also have the Pennsylvania Railroad Company. Again, this is just a standard 2-sharer, but again, different type of train, still delivering freight. We've got Reading Railroad as well. But this is listed under Reading Company. But again, 100 share stock certificate. This was listed in 1965 on here. But again, just another cool one, like some cool things here. Now, we had to sort of find a fourth one to kind of complete this set for me personally, but it was still kind of a fun exercise. So we ended up getting our hands on the New York Central Railroad Company. This is a 40 share hold. Just again, kind of a cool thing. This one specifically was issued in 1957, but sort of another cool example of just what a stock certificate looked like. And I thought that I would share these both because they're kind of a fun thing to have, especially if you're into the markets and you're into sort of the education around markets. But it's sort of a good reminder, and I do this with a lot of folks that I'm friendly with, or even my son and daughter, and we think about like, this is really representative of what you're buying. We don't think about it in terms of like getting a piece of paper or, this big old certificate here. We think about it in terms of like, oh, I own 50 shares of XYZ. And really, it's important to remember that, with that certificate comes a lot of rights. The right to vote, the right to have say in what the company does, the right to receive profit via dividends or growth, the right to call in and speak to investor relations, join analyst calls and ask questions. I think that sometimes having the paper form, it feels so much more real than just looking at it from within an app or an account where, you sort of come and go, you pick what you like and you buy different shares. Yes, it's all done electronically now, but at the end of the day, it's no different than the certificate in my hand. You still have the rights. You still have the same obligations. You should still be voting. You should still be having a say in that company. If you don't think that things are the way they should be, you should say something. I think that's it. I try to have fun on Sundays and not think too much about the market ahead, but I do inevitably think about it. And I'll just leave you with this. We're seeing some mega mergers and acquisitions going down, even in spaces that aren't traditionally seeing it. P&E activity or private equity activity is through the roof. It seems almost like every mid-market company out there is either being acquired, has been acquired, or is getting ready to be exited. So, they're interesting times for sure. I think this is the conversation we have quite often on here is really make sure that you're targeting a risk and understanding what can happen. The market can move in funny ways. It can be affected in different ways. We typically don't see unilateral movement of a stock when things go the wrong way, right? If something happens with Tesla that's negative, it brings down a lot of tech stocks. Conversely, if something positive happens, it tends to bring them all up. So, this goes back to the idea of diversification. Make sure that your underlying holdings actually have that level of diversification you're looking for. I do understand, of course, and I want to be clear that, sometimes when you're getting started or you're brand new to this, it is just a better move and easier to manage if you look at like 1 or 2 or 3 market-based indexes or ETFs. 100% totally cool. What I'm just saying is don't be fooled into thinking you have diversification where you don't. Right? If you love those top companies in VTI, for example, great. But make sure you're not just buying them over and over again across different ETFs with different price points, because this is where there's a whole nother conversation around expense ratios and what you're getting for it. So anyways, it's a Sunday. I hope everyone has a great day. I hope you kick the week off really well. I know that I typically start to watch the markets open up overseas tonight and start to plan out my trades and my investments for the week based on what's happening overseas. Maybe we'll do another video on that eventually, how we look at that and how we analyze that to give us some sort of an idea of future expectations, where the markets might open, what futures are telling us. But that's a horse of a different color. I'm going to go pack up these stock certificates, which I love looking at because they're just fun, especially when in the space. And I hope you have a good weekend and profitable trading. So talk to you later. Thanks.